Can bonds lose value when inflation is high? Imagine you buy a bond, which is like lending money to a government or a company. They promise to pay you interest every year and return your original money when the bond ends. But what happens if prices for things like food and clothes start rising fast? That's what we call inflation. When inflation is high, the money you get from your bond doesn't stretch as far. The fixed interest payments you receive are now worth less because prices have gone up. So, even though you get the same dollar amount, it can buy fewer goods and services. This means your bond's real value, or what it can buy, drops. Because of this, investors want higher interest rates on new bonds when inflation is high. If new bonds pay more interest, existing bonds with lower fixed rates become less appealing. To sell these older bonds before they mature, you might have to lower their price. That's how the market value of your bond can fall, even if the issuer still plans to pay you back the original amount at the end. Long-term bonds are especially affected because they lock in a fixed interest rate for many years. If inflation spikes during that time, the fixed payments lose more of their buying power. Short-term bonds are less affected because they mature sooner, so investors can reinvest at higher rates more quickly. There are bonds called inflation-protected bonds, like Treasury Inflation-Protected Securities. These bonds change their principal and interest payments based on inflation measures. They help guard your money against inflation, but even these can lose value if market interest rates rise or other conditions change. To sum it up, high inflation reduces what your fixed interest payments can buy. Rising inflation often causes interest rates to go up, which then lowers the market price of existing bonds. Long-term bonds are more vulnerable to losing value during inflation spikes. Inflation-protected bonds offer some safety, but they aren't completely immune to market changes. If you hold bonds until they mature, you avoid market price drops, but inflation can still eat away at your purchasing power. For teens learning about investing, it's good to remember that bonds are generally safer than stocks, but they aren't risk-free during times of high inflation. Knowing how inflation impacts bonds can help you make smarter choices about where to put your money and how to grow your wealth over time.